I think it was Lenin that said there's decades where nothing happens and weeks where decades happen. And in the last 2 weeks, we've certainly seen things unfolding in the banking sector at almost warp speed. So how did this happen? Well, central banks, as we know, for the last year or so have been raising rates non-stop. The Reserve Bank of Australia has raised rates after its last 10 meetings. Now, there's a belief that central banks raise rates until something snaps. And we certainly saw the rubber band snap in the United States. Several banks in the US that no one's heard of ran into trouble, not because of reckless lending practices or taking excessive risks, but basically as a result of the Fed raising rates so fast and so high in the last 12 months. So Silicon Valley Bank, for example, received a lot of deposits from corporate clients. It doubled its balance sheet over the last 2 years. When it received that money, what it did with it was to buy US Treasuries, long-term bonds, government bonds, which should be risk-free, and they are. But the problem is, when rates rose, the value of the bonds fell. And as some of those depositors took money out, the bonds had to be sold, so they had the cash to pay out the depositors, and they took a loss because the bonds were less in value. They dropped in value. So there was a shortfall of capital. As word got around that that bank may have some issues, and that became evident when it decided to do a capital raising, so more and more depositors took money out of this bank to put it into safer banks, the larger banks. Essentially, it was a run on the bank, and no bank can survive a run, no matter how well capitalised it is. So the Fed had to step in. It said that it was a systemically important financial institution, meaning that it was too big to fail, even though nobody's ever really heard of this bank. So it stepped in, it made the deposits good, and that bank was bailed out, but that spread to some other smaller banks as well. And a number of banks found that their depositors, their customers, were taking money out and doing the same thing. So the Fed had to step in to save those banks too. And there's a lot of banks in the US, smaller regional banks that we've never heard of, and they're at risk of the same thing happening. So I think there's going to be a little bit more of this to come. I don't think there'll be a contagion though. This is not like the GFC. The GFC, it was because banks had invested heavily in really toxic assets. Do you remember the subprime mortgages and those mortgage-backed securities, collateralized debt obligations, which they thought were safe, but weren't safe at all. And they lost their capital, and that led to the worst banking crisis since the Great Depression. I don't think that's going to happen now. Credit Suisse was another kettle of fish. It had been mismanaged for about 15 years. It had taken risks. Ironically, it survived the GFC better than most banks, but then it seemed to get a bit reckless. Maybe it believed its own hubris. It had taken risks, and that costed a lot of money. A couple of examples: it had lent money to a family office called Archegos, and it hadn't done its due diligence, and there were margin calls on that family office. It didn't have the assets to meet those margin calls, and Credit Suisse and a number of other banks took multi-billion dollar losses. And then there was our very own Lex Greensill, who was running a factoring company, and Credit Suisse had backed him to the tune of billions of dollars, and Lex ended up going bust as well. So those two things, I think, in the last 2 years sounded the death knell for Credit Suisse. And as we know, it's now been bailed out by the Swiss National Bank and has been folded into UBS. what happened at Credit Suisse was a bit more like the GFC, but again, I don't think the contagion is going to spread. So we've seen a lot of action in the last 2 weeks. It has spread to our market. It has affected things like, bank shares and the market generally, but particularly bank capital notes, because one thing that happened with Credit Suisse was that its bank capital notes got wiped out. Note holders, they did their capital, which is ironic because they should be lower risk than normal equity. But the equity holders, whilst they took a loss, they got something. But those capital note holders, which are not like our capital notes, by the way, our capital notes are different. They're more convertible capital notes. But they were wiped out. So that's where we're at the moment. I think there'll be a little bit more to come. I think it's going to be an interesting year. I'd say at the moment we're probably in the first innings, but I don't think it's going to be anything like we saw in 2007, 2008. I think the markets will be volatile and probably somewhat weaker, as we've seen in the last couple of weeks. But I don't think there's anything to be too concerned about.